This is our Forex blog for May 14th, 2013, and I'm going to link all these charts together so that we can scroll them back and have them all line up with each other. So once they're all the same color up here, if you click our demo trading button, you can scroll one chart back and they're all line up. And these are our currency indexes, which is one of our best tools because it lets you actually see each individual currency, and then you just simply look to and you focus on buying the strongest ones versus the weak and selling the weakest versus the strong, depending on which currency is on top or bottom. The charts give you a wealth of information. You have the previous day's high in dotted green, previous day's low in dotted red. When a currency is not able to go underneath its previous day's low, and then you see it break out from below to above the hourly moving average in gray here, that's a trend that's pretty likely to go up. You can see that happen here. False breakout here, this one worked, this one worked, this breakout here worked. Breakouts from above to below the hourly, this one worked incredibly well. And underneath that you can see the daily trend, weekly trend, and you can also put the monthly trend, and you can also set these up with our currency meter to see how strong statistically each currency is in real time, bar by bar. You can put those on there as well. It makes it even easier. So basically, in a nutshell, you're looking to buy the strongest ones versus the weak and sell the weakest ones versus the strong. There's also a lot of patterns that work really well. For example, sideways rectangle patterns, low volatility breakouts. This one had a false breakout here which failed, and the second one exploded up. You had the exact opposite. Well, you had a breakout here that failed, but it went up for 10 minutes. Usually it's enough to move your stock to break even. You're not going to have a loss, and then when it breaks out to the downside, you go short. Plus, when you see the weekly trend so weak and the daily trends weak, it's obviously much more likely to go down. Everyone knows to trade with the trend, but you don't necessarily, most new traders don't know what time frame trend to use. Real-time trend, 5-minute trend, half-hour trend, hourly trend, 4-hour trend, daily trend, weekly trend, monthly trend. Which trend do you use? They can all be going in opposite directions. In other words, the New Zealand can be going up in real time, the daily trend can be up, the weekly trend can be down. So if that's the case, more cautiously trade on the upside when it's going up. Draw your trend line on this. When it breaks the trend line, you would love to go short here because the weekly trend's down and probably the monthly trend's down. And you also have a nice little rectangle pattern right here. When that breaks out, that's a trend that's very likely to reverse. Breakouts to the upside, if the longer time frame trend is down, they're less likely to work. You also have resistance and support. In this case, the yellow line, very important. It is the most actively traded price in all the CAD pairs yesterday, and you can see that it went up 38 pips yesterday. The thicker one is the previous week's point of control. This is market profile technology. Just keep in mind that it lets you know where most traders have their positions last week and the previous day. You can see the pound, all the time frame trends are down. Pretty much it's underneath the hourly, it's underneath last week's average price, it's underneath yesterday's average price. And so when this one broke this nice little trend line on this counter trend move up, very high probability trade here at 8:30. So let's start with that one as far as lining up the currencies. Which one at 8:30 was very strong? Well, the dollar was. It was above its previous day's high. At 8:30, the euro's going up. You can see the daily and weekly trend are pretty much up. At 8:30, the Swiss, most of the time frames are up. It's still underneath its hourly, but because all the time frames, the longer time frame trends are up, you probably can buy that one. Also note it's above the price where most traders have their average position the previous day, and it acted as support. These value areas for the previous day and previous week tend to act as support resistance. So let's take a look at 8:30, selling the pound versus the dollar, the euro, and the Swiss. We'll start with the dollar because most people trade that one. And you can use any time frame chart for this, but we'll take, sorry about that, pound, dollar, 8:30. Pound is likely to go down, the dollar is likely to go up. Here's 8:30. This one had a nice little pullback. You got hourly moving average as resistance. And anytime you can get into a trade where maybe you put your stop a little bit above the hourly here, and our lower containment bands make a good profit target, this is 2.5, 3 times bigger potential profit than what your risk is. Very high probability. And typically when price gets on the perfect oscillator outside of either the Bollinger Bands around that or the -80 level, you tend to get reversals. As you can see, reversal up, right here, somewhat of a reversal up, and the market's really at an extreme low right here, reverses up. Notice earlier, reversed up. Notice the high right here, reversed down. And so anytime you have a trend that's down and you get a nice move, counter trend move, and it's at the plus 80 level, great place to sell. You can see it again here. You can also use the upper Bollinger Bands as areas to sell. Very high probability because it's all based on statistics of each currency for that time of the day. But nonetheless, you have a nice trade here. You probably would have looked to sell this little pullback right here as well. So you got 1 trade, 2 trades, 3 trades, 4 trades, 5 trades, and you also know where to get out. You know, again, when the currency is below the lower Bollinger Band, or especially when it hits the minus 80 level, very high probability, especially for scalping. And some traders, you know, like to take trades that are high probability, counter trend, short, counter trend. You probably would have lost on that, made money, counter trend, made money, counter trend, made money, made money. You know, it's debatable whether you made money in that tiny one, made money, made money. And the key is small losses, big wins. That's it. There's nothing rocket science about trading. So we knew the pound was likely to go down. All the time frames are down. It hit a major resistance area. We see the euro going up, the Swiss going up. You could buy the euro pound at 830, and as you can see, at 830, this one, I like it when the currency is coming up to the hourly and going sideways like that. When it breaks out, it's very high probability, because basically most longer term traders, the people who move the Forex markets, are longer term traders. Hourly is a very popular, probably the most popular time frame for longer term traders. And if a currency goes from underneath above its hourly, everyone who's short pretty much has stops right around there. So when stops get triggered, boom, goes right to the outer bands. Let's take a look at the the pound Swiss. Weak pound, strong Swiss, 830, very likely to go up. And you can see on this pullback, actually 830 is likely to go down. Pound's weak, Swiss is strong. This one's above the hourly though, so you might want to be a little careful or wait for it to break the hourly. It happened about half an hour later. Using a tick chart or a range chart, you might have got into this. Just sold this little pullback right here. Super tight stop, and I probably would have got out of half my trade here at the hourly. You don't know it's going to break, and once it does, then you want to draw your fibs on the first swing, and if it's super weak, it might make its way down to the 1.618. Most times, probably 75-80% of the time, markets don't go underneath the 1.618, and that's your maximum profit. You can see also it's pretty close to the minus 80 level, 1.618. Get out of that trade. So whether you're short here, this is how much you made on that trade with your stop maybe above the swing high, or if you're really aggressive, right above the hourly. Super tiny stop, super tiny risk, big potential profit. In this case, it hit. Not all the trades are going to hit. And there's so many ways to trade with this. You can draw trend channels on this and project that from the high and actually look for sells at the upper quadrant here. Or you can just draw a trend line, duplicate the trend line, and project it from the high. At 11:30, the euro is likely to go down, even though it's in a strong uptrend. So at 11:30, which one was possibly likely to go up? I would say probably the Swiss, because I made a nice size pullback right here, and it found support at the point of control right here. So at 11:30, we're going to look to sell the euro Swiss. These are just a few of probably hundreds of ways to anticipate future direction. 11:30, the euro Swiss is likely to come down. You can see the price is actually above the 2.0 band. Price is off the charts under a perfect oscillator, which means it's one of the bigger moves it's made in a long time, especially for this time of the day. Take your trade, put your stop above the high here, and just trail your stop. In this case, you might have only made 5 or 6 pips. And probably more likely, you're going to, for any kind of counter trend trade, you're going to want to use a tick or a very fast range chart. So let's just take a look at this. Maybe this is not one I trade that often, maybe 40 ticks per bar. And 11:30, you can much more accurately, usually on a range or tick chart, get short, put your stop right above the high, and in this case, there wasn't much of a pullback. But at least you can take riskier trades with much less risk. And you can also go to a 3 or 4 pips per bar range chart too, and wait for one down bar before you get short. So basically you would get short right here, put your stop a pip over that, and when it comes down and reverses, you're out with a very tiny profit, or break even depending on what your spread is. You also, when the markets are up too much and above our containment bands, if you draw your fibs on there, normally what I do is if I take a stab at it and make a little bit or lose a little bit, I'll draw my fibs on the whole thing, kind of wait for it to get up here, and then I'll tend to scale into bigger positions. Right here, I would have kind of expected a little bit deeper pullback. When it can't get over the high here, I might add to my position, and then when it breaks this trend line here, probably add a little bit more to it, and then out of this maybe 15 pips. And because it didn't pull back that much, I'm looking to go short again up here. Probably would have got into a little bit of position here, added progressively. Let's see how that one ultimately pulled back. Yeah, a lot of times on counter trend trades you can expect a two-wave pullback, so the fib areas are great places to get out. You might scale into a trade up here at 24.95 to 2,500 and out at 77. And you can put on big positions doing that, especially above our upper containment bands. And also, as you can see here, the first wave up typically can go above the upper containment, or the perfect oscillators plus 80. But notice here and here, pretty much where it runs out of steam. These become essential for timing counter trend trades of just off the charts aggressive trends. And if you can find a currency this strong and still make money doing counter trend, you're doing good. And you can see it broke out of that channel. So once a currency breaks out of its channel, it's more safe to do counter trend trades in it on the next wave up. The only reason that one continued on up is because the Swiss became super weak. And so that being said, the Swiss couldn't get above its previous day's high here. Unfortunately, the daily and weekly trend are up at that time, but when it breaks down under its point of control right here at 1230, you want to trade that against whatever's strongest. You can see the euro strong, the dollar strong, the CAD is starting to get strong. The daily trend just shifted up. So obviously 1230, we have euro Swiss buy and also dollar Swiss buy. And so obviously that trade that we were looking for counter trend, if you're watching that chart, you notice that the Swiss broke down and wasn't getting stronger. So you exit your counter trend short and go long. And typically I won't buy above the upper band. Sometimes I do, but usually no more than 5 or 10 pips. So I would not have taken this buy here, but this one went from above the band back below it. The majority of time, price does not break outside these 2.0 bands, and when they do, typically within 2 or 3 hours they'll come back into the range, as you can see here, here. Let's go over one of my other favorite trades for the last example. The Australian longer time frame trends down, comes down to the previous day's low and access support. We have a false breakout and comes back up. It's not even able to make it to the hourly moving average, which most of the time it does, and breaks down again. This is super high probability likely to go down, and it's also likely to go down to the fib target of this. So you have the first fib target, second fib target as potential profits. If you're short any Australian pair, when it hits this area, if it goes through it, then typically you're going to want to get out somewhere at the 1.618. Sell the Australian here at 530 when it breaks down versus whatever one's strong. You can see the dollar's going up, the euro's already strong, the yen is also strong, although the weekly trend's down. So basically you would sell the Australian dollar, Australian yen, and also look to buy the euro Australian. So let's just take a look at these real quick. Here's the Australian dollar, 530. Notice this one also broke from above to below its hourly moving average, came back up, false breakout. Very high probability place to sell right here with your stop above here, or if you're super aggressive above the previous bar. Lower containment band's an excellent place to get out of your trade. And if you look at this one, you'll understand why I say it doesn't make sense to sell a currency underneath its lower band, because it's statistically gone too far. And a completely separate indicator is the perfect oscillator tends to show reversals when it's at minus 80. And you can see pretty much every time it either went sideways or reversed, sideways, sideways, some kind of reversal, 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 sideways. When they hit this area, most of the time it's either going to go sideways or reverse. A very small percentage of the time it'll continue. And typically, when it's in the middle of the range like this, it's much more likely to continue than when it's at the lower band. If you see a minus 80 reading and it's in the middle of the range, you can still look to sell it. And that's the Australian dollar. Let's take a look at the Euro Aussie at 530. This one's very likely to go up. Strong Australian, weak Australian dollar. Here's 530. Had a little bit of a pullback. One of the ways I use the perfect oscillator is if you get a pullback and it hits the Bollinger Band on the perfect oscillator, it's a pretty high probability place. Again, notice the 2.0 band where the market reverses. So don't be greedy when it's out there, and especially when you have a perfect oscillator extreme reading, you might want to take your profit. Don't be greedy. The last one was the yen. It was going strong at 530. Although it was lower odds than the euro or the dollar because the longer term trend was up on both. At 530, you want to look for a sell in this. And you can see it had a little bit of a pullback right here. And this is kind of what I had in mind with the other one. When a currency goes outside of its upper or lower Bollinger Bands, it almost always reverses back into it. So once it does, it becomes a pretty safe place to look to sell. You could, on a 5-minute chart here, just sell the low of that 5-minute bar with your stop above here. And anytime you're risking such a tiny amount, less than 10 pips, you have a very good shot of making many multiples more of what your risk is. The tighter your stop and the higher your winning percentage with our tools, the more money you're going to make. And not only that, but it makes it a joy to trade.